Good afternoon, everyone. Welcome to this webinar on outlook and opportunities. And we have with us Roshi Jain, who is our senior fund manager. As you all know, she handles our Flexi Cap Fund and Focus Fund for nearly 3 years now. So to start with, I mean, we all know that the markets have seen some amount of correction, in fact, quite a bit of correction over the last 6 months or so, with corrections coming more in mid caps and small caps in the last couple of months as compared to the large caps. More or less, the corrections have been seen in many sectors. While I just want to refer to our yearbook, which we released a couple of months ago, we did mention in the yearbook we released in Jan that the markets are trading at kind of a high valuation levels. In fact, there is one of the slides in which we highlighted the premiums at which the markets were trading, especially in the small and mid cap segment. So at this time, the markets have corrected from then on further, and we are eager to hear from Roshi Jain in terms of her overall outlook. Has the valuation come to a comfortable level? Is it the time to invest more in equity? So a lot of questions are there on people's mind.
So I'll just keep it simple and straight that equity investing have been very simple and complex at the same time. And why I'm saying that just if you go 6 months ago, end of September, market was in euphoric mode, and people always tend to extrapolate what's happening at a particular point in time. And like they said, that's an endless story, and the things will continue to improve from here on. And down the 6 months line today, when we talk, then people continue to think the same way, but on the opposite side, that markets are going to be like this, and things are very difficult to improve. And why I'm saying that despite all kinds of news flows coming in terms of from the RBI side, from government side, in terms of providing liquidity, in terms of providing tax incentives, and overall, growth rebounding back from what we saw in the September from 5.4 to now 6.6 plus, and things, but still people tend to then ignore their sort of all the positives coming and continue with their idea idea of the pessimism. So we always say that the market sentiment is like a pendulum from optimism to pessimism and so on and so forth. So before we invite, I just thought let me spend a couple of minutes just sharing thoughts, because I've been in this business for more than 3 decades, and I've seen a couple of markets which always reflects the mood at that particular point in time, and I've seen much deeper correction. So if you look back and say, Ram, are you able to get the slides?
I am screening, but for some reason it's not coming. That's what people are telling me.
So let me continue with this. That if you have observed the markets for last maybe that I've been in the business for 30 years, that corrections is part and parcel of this market. And from time to time, markets have been correcting, sometimes very deep, sometimes shallow, but on an average, 10-15% correction is very normal, and every year it happens. And if you see this time also from September end, markets have corrected by nearly 16%. Of course, now it's rebounding a bit, but this kind of correction that we have seen always in the market. What is more important? What is more important at the point in time that the changing sort of paradigm as far as Indian investing is concerned. Hitherto, when we started in the decades of 90s and thereafter, markets were quite dominated by the FI flows. So when they used to come in, markets used to go up very sharply. When they used to move out, market used to correct sharply. But this time, despite record flows, I think markets have not corrected sharply. And this is all thanks to the retail investors who have participated magnificently over the last couple of years, especially after the COVID. And as we speak, for the 11-month period ended this FITD, the mutual fund inflows on a net basis is in excess of 5 lakh crores. So that's a record as far as history of mutual fund in terms of net sales is concerned. So this is the mood of the nation. This is what is happening from a perspective. Now, coming back to the idea of mutual fund investing, of course, Roshi is with us, and she will be speaking at length on the markets and economy and her thoughts. What are the opportunities, where are the opportunities lying? But what is important for you to understand that she has been managing the one of the strategy, which is our flagship strategy, which is the HDFC Flexi Cap, which she has been managing for now little under 3 years. She has been with us and comes with a solid experience of more than 2 decades in fund management and research. And if you really see from a perspective, what the recently that fund completed 30 years and 1 lakh invested. Ram, you can go to the next slide. So 1 lakh invested over a period of time. If you see this slide, if you see this is the fund which has seen so many ups and down cycles and various events which are global in nature, which are local in nature, but that 1 lakh is very close to or over 1.7 crores over a period of 30 years. So before this correction, it used to be close to 1.9 crore. Now the corrections have taken place, so it is slightly corrected, but still it is 1.7 crores. Now, Ram, go to next slide. Now, what is important that what is the core to HDFC Mutual Fund per se, and of course for this fund also in particular, when you look at that, how your wealth, you are outperforming benchmark over last 30 years, you have created wealth for investors. How does this happen? The core philosophy which we follow at HDFC Mutual Fund is that avoid big mistakes, and therefore even in this correction, which you can see since September, whatever has happened, the fund has lost 12%. So it is not possible that the market goes down and the NAVs will not fall. Or maybe will fall. But what is important from a fund management perspective, that you fall less than the market, and when the market goes up, you rise more than the market. So while the category average has fallen by 18.5%, all flexi cap put together, and benchmark, which is 500, also has fallen by nearly 18.5%. This fund has fallen only by 12.5%. That's how it has fallen less by 6%. And that's for it creates wealth over a longer period. Ram, next slide. And the same thing if you see on last 1 year, and this is a predominantly a large cap portfolio. And we always say that in fund management, it's a stock selection which is paramount, which creates alpha, which creates wealth for its investors. So this fund over last 1 year, despite the correction as on February end, has grown by 9%. But if you see Nifty 100 or Nifty 500 or even then mid cap and small cap indices, they all are either in minus or they are just around 1%. So stock selection is very key in fund management, and that's what this strategy is demonstrating. If you go back to the first slide and remember how it has created wealth of 1 lakh becoming 1.7 or 1.8 crores, is because of this core philosophy that you avoid big mistakes. Ram, next slide. And it's not that. What is important for us to, from investor perspective, is that it's not that this fund did not have a bad times. This fund over a period of 30 years also had time or years when it did not do well. So you can see the red cells, which are the period when it did underperform its benchmark. But largely, if you see, it has outperformed its benchmark. But those people, instead of moving out of the fund and taking a timely call, etc., and trying to time the market, actually have lost out. But those people who have stayed with the fund actually have created wealth. And therefore, we always believe that the stock market is devised for transferring money from impatient to the patient. So those people who have been patient with this fund actually have earned its wealth, earned their wealth, created wealth for themselves, rather than those people who thought of timing the market and moving in and out. And that has not helped the investors. And that's what we say, that even if you look at this way, that you try to time the market, you miss the best 30 days, your return, which was like roughly around 19% since inception, falls to 12.5%. So you just need drop of really 7% on compounded basis. In terms of wealth, you can see from 18 lakh, the money becomes only around 3.5 lakhs. So don't try to time the market. As we say, if you believe in a fund, believe in the way the fund is managed, believe the core risk management or portfolio selection, there will be time when the portfolio may not do as per your expectation. But if the long-term track record with whatever negatives happen in the Indian markets or because of the global reasons or because of the local reasons, but those who have remained steadfast, patiently investors actually have created wealth for themselves. And therefore, Aram, next slide. And therefore, since this track record, you can see on an average, this fund has double its NAV every 4 years. That's what we don't say that it will continue to do so in times to come, but this is the track record. Sometimes it has taken a little more time, sometimes it has taken less time. On an average, it has continued to double its NAV over a period of 4 years, only because of the philosophy and the stock selection and risk management that we put into practice. And because of this, the 10,000 rupees SIP invested over the years, and for this figure is as of 31st December 2024, the value of 10,000 rupee SIP, which is like roughly 36 lakh rupees over a 30 years, is today close to 20 crores. Of course, with market correcting, it would have reduced lower. So again, coming back to same kind of disclaimer, past performance is no guarantee for future, but idea here is to say that the patience actually has helped investor earn this kind of wealth if a fund continues to follow a disciplined approach to its investment process. And finally, before I hand it over to this is the Kumbh Mahakumbh, which recently ended. And if you see this conglomeration, those people, I think many people would have gone and visited this Mahakumbh. It gives you flavor of what India is all about. And that what reported news is that they've nearly generated revenue of 3 lakh to 3.5 lakh crore of revenue for the around Mahakumbh. And if this is the kind of revenue this festival is a sort of gathered or collected, then this money eventually will find its flow or will flow into the Indian economy over a period of time. And with that, steps taken by RBI in terms of infusing liquidity into the system and tax liquidity was provided by the fiscal government. There are a lot of positives which are, in my opinion, in our opinion, is coming through. But then without doing much ado, I will now invite Roshi to share her thoughts. And of course, this is a disclaimer that we have to follow for whatever the fund has to done. But now I invite Roshi to share her thoughts on the Indian economy, markets, valuation landscape, and what she believes in Flexi as a strategy, the way forward.
Good afternoon. So let's jump in. We will discuss some of the pointers in terms of what we think are the drivers for the markets from a long-term perspective going ahead. And we will also discuss the risk because obviously it's unfair to be only looking at one side of the coin. In terms of catalysts, we of course have a host of them over the medium term, ranging from manufacturing, services, private CAPEX. And on the risk side, I think concerns range around growth, inflation, interest rates, as well as geopolitical uncertainty. So let's tackle them all one by one. From a more medium-term perspective, we think that manufacturing will surely emerge as one of the key catalysts for growth in the economy. The manufacturing intensity in India has sort of come off actually over the past decade. The government has initiated the Make in India initiative in order to enhance manufacturing's share in GDP. There are a few factors which will aid that, in our opinion. The first, of course, is that from a cost perspective, we are extremely competitive versus the rest of the world. Even if you just take China as an example, I think we are now at about a fifth of the labor costs of China. So clearly there is a big cost advantage. There's also the imperative of diversification of supply chains post-COVID that has gained urgency. In addition, the various geopolitical compulsions are making diversification another imperative. And you put the two of them together, and then the support from government in the form of tax incentives, PLI, etc. We think that manufacturing is a sustainable medium-term theme. And the reason manufacturing is such a big opportunity is the chart on the right, where you will see that our share in global merchandise exports is still extremely small. And therefore, while we will talk about some of the tariff-related issues, I think if you put that in context to where we are and the opportunity, I would think that the opportunity over the medium term is a lot bigger than the shorter term, nearer term risk that we face. The chart on the left really shows various countries and how manufacturing has been key to their development, whether it is advanced economies like the US, South Korea, or emerging market peers like Indonesia, Vietnam, you will see that most countries have adopted the manufacturing route at some point in their economic cycle. And I think from that perspective, it's also important for India to be focusing on manufacturing more from a perspective of providing jobs, as well as also from the perspective of having more dependence on local manufacturing from a current account balancing perspective. So I think sum and substance is that there is an advantage that India has. We are extremely small in the overall scheme of things, and therefore, if we put that advantage to good use, I think the opportunity ahead of us is still very big. The services-driven exports model, of course, continues to stay robust. In addition to IT services, we are also seeing the growth of other services, largely on account of the availability of STEM graduates in India. The availability of talent is also now attracting global captives in India, especially post COVID, where work from home had become a feature, and that slowly translated into offshoring as well. We've seen the number of global capability centers go up from about 1,400 in FY19 to about 1,700 in FY24. A strength, as you can see on the chart on the right, is that our share in services exports is higher than our share in goods exports, largely because of the availability of talent at lower costs. The next catalyst, I think, is also from a banking system perspective. The last decade saw significant changes in the banking landscape, and post that, we've seen that the banking system is now fairly robust. A healthy banking system is a prerequisite for sustainable economic growth, and I think from that perspective, India check boxes this requirement fairly well. As you can see from a NPA perspective, we are fairly in a comfortable position. Advances growth had flagged off a bit, but as Ashok had also mentioned earlier, given the monetary easing that we are starting to see, I think that we now seem set for system loan growth to pick up. Step up in private CAPEX is another catalyst which we think will play out over the next few years. If you look at the listed space in particular, we have seen a pickup in the CAPEX of listed corporates in FY23 and FY24. This year, FY25 has been a bit soft on account of uncertainties. But if you look at the investment boom in the 2000s periods, it was driven by private CAPEX, and thereafter the contribution of private CAPEX to overall GDP has been flagging off. But we think that we are now at a stage where the stars are all aligned for private CAPEX to pick up. The recent uptick in CAPEX has been mostly government-driven as well as household-driven, and private corporates have been lagging. But we do think that over the next few years, we will start to see an improvement in private CAPEX contribution as well, driven by just the capacity utilization reaching thresholds where additional capacity is required, driven by corporate leverage being at 15-year lows, and driven by increase in manufacturing intensity, the first step of which is, of course, setting up of capacity. So we do think that there is a suitable environment, and we should start to see corporate CAPEX pick up over the next few years. Infrastructure, which really has been a key contributor to gross capital formation over the last few years, driven by government stepping in. We've seen significant growth in government CAPEX over the last few years. We think that there will continue to be growth, albeit at a lower pace, more in line at which government revenues are growing. So it will continue to remain a fairly robust number, albeit at a pace which is lower than what we've seen from the period FY19 to FY25, given that the government also has to balance the fiscal prudence with growth. Housing cycle recovery, we are somewhere in the middle of that housing cycle recovery, which perhaps began somewhere in FY21-22. Housing affordability continues to stay reasonably robust. Inventory levels in the system are also, indicative of the fact that the housing cycle recovery still has more legs to run. However, one feature of the housing cycle recovery has been the growth at the affluent level as opposed to the affordable level. The other trend that has been supportive of the housing cycle recovery has been reforms such as RERA, which have renewed buyer confidence. And this is something that is, of course, a lasting reform, which will continue to have a positive sentiment effect, as well as from a listed universe perspective, at least greater consolidation and formalization of the sector. A quick check of how India rates versus other economies. From a growth perspective, of course, the growth premium remains. But the more important thing, I think, is the chart on the right, which shows how the growth has come without deterioration in the quality of the overall balance sheet of the country. So if you look at the chart on the right, in the 2000s, India and China were at similar debt to GDP levels, the lines in blue and red respectively. And you will see how divergent the paths have been. China has nearly doubled the debt to GDP ratio itself, whereas India has more or less consolidated around that level, which tells you that growth in India has been a lot less debt dependent, as has been unlike the case of China, where we've seen significant leverage addition. And I think this macroeconomic stability is something that holds India in very good stead over the medium term. The other interesting feature, of course, has been the significant retail participation in markets. Household savings and equities as a percentage of financial assets is now 20%. And most of the FII selling over the last few years have been more than well countered by domestic buying. I think what it also does is that it creates a fairly large category, unlike in the past where FIIs were a fairly large category, and the market volatility used to be driven by FIIs coming in or going out. I think you now have a fairly large countervailing counterparty on the other side, equally large as the FIIs, and therefore I think that perhaps makes the market less susceptible to shocks coming in just from FII inflows and outflows. Let's also talk about some of the risks over the medium term. I think primary risk is perhaps the slowing global growth in the context of high leverage. We are already starting to see some challenges to or a slowing down in terms of the US personal consumption expenditure, and that in the context of extremely high leverage globally, I think is clearly something that we need to be cognizant of. Tariffs, again, while it will have some impact on growth, even India, despite India being a predominantly domestic-oriented economy. However, it does appear that the challenge to India is a lot lower than it is versus several other countries. And as I was highlighting earlier, given our very small presence on the global scale from a manufacturing perspective, I would think that the opportunity is much larger than the near term, which of course will play out over the medium term, is much larger than the immediate risk from a tariffs perspective. The other challenge, of course, is the uneven consumption recovery. India's consumption recovery post-COVID has been, as we all know, a little bit lopsided in the sense that the affluent part of society has been driving consumption growth. And we've put some examples here where we compare, for example, the large SUVs versus the hatchback sales, for example, where in the last 3 years, while large SUVs have grown at 6 times, the compact segment has actually declined. Similarly, in the case of, we've just taken some example of premium spirits versus regular spirits. And I think some of the reasons for that are, of course, fairly weak income growth, both in rural and urban. Urban, of course, was supported post-COVID, especially by the IT segment, given the demand for IT-related work during FY 21-22, but that has also started flagging off. So we've seen weak income growth, and also lately, given tightening of credit norms, we've also seen some slowdown in retail credit. So I think that this is also, this cyclical challenge in consumption has also led to uneven consumption growth, which is something that also we need to sort of keep evaluating. The counters, there is of course some counter to that uneven consumption recovery. I think governments are aware that the lower part of the society still has challenges in terms of income, and we've seen them stepping in through tax measures, as well as at the state level welfare measures, which in our estimate aggregate to about 3 lakh crore in terms of announcements made by states. Inflation, the other thing that we need to be cognizant of from a medium-term perspective. I know that in the nearer term, there are perhaps not as much risks to inflation, but in the medium term, I think this is something that we need to be cognizant of, given geopolitical uncertainty, how supply chains get realigned, the impact of tariffs, demographic changes, climate change. So I think there are fairly large inflationary pressures as well in the globally, not just in India, and this is something that we just need to be aware of. And this obviously then also has an impact on interest rates, because we are already seeing countries run fairly high fiscal deficits versus, let's say, levels almost 15 years ago. We've put that comparison in the middle chart, where you can see government deficits in 2006 were much lower than what they are in 2024. That clearly is an inflationary factor. And the tight labor market, given the demographic changes, central bank balance sheets being still significantly larger than they were pre-COVID. So putting all that together, I think interest rates, perhaps this decade, may not see the kind of lows that we saw in the previous decade. Geopolitical environment, of course, a lot of uncertainty, which throws up opportunities perhaps in the medium term, but clearly risks in the nearer term. And we don't have a dearth of uncertainties around geopolitical events, etc. So again, something that will keep markets perhaps volatile. And finally, on valuations, the slide that you're seeing here is the Nifty 50 valuations, where the 1-year forward PE now at the index level is pretty much in line with the last 10-year average. But if you look at the chart on the right, you will see that sectorally there are fairly wide dispersion in terms of how individual sectors look relative to their last 10-year average. This chart covers the mid-cap as well as the small-cap valuations. So mid-caps, even post the correction, are still trading at about 26.5 times 1-year forward PE versus a long period 10-year average of 21.5. So still significant premium there. Similarly, small caps trading at a 1-year forward PE of 20.5 times versus the last 10-year average of 17. So despite the correction, valuations are still at elevated levels for both mid caps and small caps. And if you then put that in context of how these valuations are relative to the large cap segment, you will see in this chart that currently the mid caps are trading at a 47% premium to the large cap universe versus a 10-year average of 17%. Similarly, small caps are trading at a 14% premium to the large cap universe versus the last 10-year average of a 8% discount. I think this this is just a final chart in terms of saying that of course themes matter, but it's important to be a lot more stock specific. And here we've just put together the last 5-year returns CAGR of the best performing Nifty 100 stock. We've not gone beyond the Nifty 100 because there could be differences in liquidity, etc. So we've stuck to the Nifty 100, and we show you here how within the same sector there can be huge disparity in returns, and therefore how it's important for us to be extremely stock selective and bottom up in terms of our portfolio construction. Just summarizing the view, therefore, it's time to be disciplined. I think this market remains a stock-specific market. There are opportunities from a long-term perspective. I think India has the structural tailwinds of demography, demand, digitization, which will all manifest in the form of perhaps better manufacturing intensity, services continuing to do well, the need for infrastructure, private CAPEX picking up. But at the same time, we need to be cognizant that globally things are impacted, are challenged by various factors such as slowing growth rate, protectionist barriers, geopolitical uncertainties, of course, high leverage as well. And the fact that valuation multiples are still in the elevated territory, which entails that we take a disciplined and long-term approach to investing as opposed to being tactical about what we do. Let me just jump to Flexi Cap. This is our investment framework. We are looking for growth, good quality growth companies, which are competitively placed in an industry where growth prospects are good. We are looking for strong managements with an ability to capitalize on opportunities while at the same time being cognizant of and managing the risks. We are looking for companies with a track record of good corporate governance, transparency, and ESG sensitivity. And our stock selection will consider the industry cycle and take a risk-adjusted view. At some points, we might have to position ahead of the market, but really what we are looking for is cycle-adjusted sustainable growth. And the second aspect of course, our investment approach is our valuation discipline. It's important for us to get these quality growth companies at reasonable valuations. And our valuation will, of course, also be long-term in nature, given that our stock selection really focuses on identifying companies with fundamental strengths. So our investment approach is really to marry the two, which is look for good quality growth companies, at the same time maintain valuation discipline. How does this all translate into FlexiCap positioning? Let me first address the question of our exposure to large, mid, and small. At this point, we are overweight the large cap space. We have a huge underweight on the mid cap space, and we are slightly overweight the small cap space. Now, of course, this is a flexi cap fund where there are no predetermined large, mid, and small cap allocations that are required to be kept. And for us, our exposure to large, mid, and small is very bottom-up driven. These are the factors on the right, as you can see, basically determine our allocations to large, mid, and small, which is that we need to find, we are looking for growth, profitability, and return outlook of companies. That's the key determinant of our criteria to add stocks in the portfolio. Valuations, of course, and then liquidity will also be a significant criteria for inclusion of stocks in the portfolio. And then finally, the market cap weight in the benchmark, which is the CNX 500. Current positioning, we are overweight the financial space. We think that credit growth, and we discussed in the previous slides how the asset quality is fairly benign, and we think that greater financialization of savings is a theme that will continue to play out over the medium to long term, and therefore BFSI for us is an overweight at this point. We are also overweight the consumer discretionary space, where we think that the long-term theme, which is that the pickup in consumer spending, it's a sustainable theme, and we think that the mass consumption, which really had been struggling over the last 3, 4, 5 years, post-COVID especially, we do see a revival in that segment. So our consumer discretionary bets are largely linked to a pickup in mass consumer spending as opposed to affluent spending, which is what we have seen over the last few years. Healthcare is a defensive segment. We have fairly diversified exposure there across domestic market, pharma, healthcare services, as well as some opportunities in the export market as well. From an underweight perspective, our large underweights are on the energy space, consumer staples, again driven by the growth outlook as well as the valuations, as well as the industrials and materials space. Again, most of our underweights are very stock specific driven, given the mismatch between the growth outlook as well as the valuations. Here you can see the top 10 stocks. We, of course, have a large presence in the BFSI space where we own several of the large banks, but also mass consumption, you will find healthcare, as well as defensives such as telecom. Cash levels are currently at about 8.5%. We also have some REITs in the portfolio to the extent of about 3%. And portfolio turnover ratio of 27%. So about a 4-year holding period on an average for the stocks in our portfolio. So I'm going to stop there.
Thanks, Roshi. Thank you very much. I think we can end the call. Ashok bhai, if you're there, thank you very much for the great intro. Thank you all the audience. And again, next month, we will be back with one more session, interesting one. Sometime around the mid-month. Our target is to do a mid-month call. Sometimes it goes a little ahead or behind. So we'll try to be back on the 15th of next month. Thank you very much. Thanks, Roshi, again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.